Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So if you are like me, you are always looking for undervalued stocks, okay? And the reason I always say find high quality businesses that are undervalued is because it's the right way to invest, okay? You do not want to buy companies when they are trading higher multiples, where you don't want to buy them when they're very, very expensive. You need to find high quality businesses that have been around quite some time, have predictable income, that have excellent free cash flow and so on. There's a list of things that you could look for in basically when you're looking for high quality companies. But the most important thing is for me is the fact that it's undervalued at the moment, and Wall Street and everybody else is overlooking that company because maybe they had a one quarter that wasn't great or whatever. Okay, and that's exactly what we're going to do today. Normally I like to do 5 companies that we could potentially buy next month, but this time I'm going to do actually 10 different companies. You might be thinking the S&P 500 has gone up so much in the last few months, how are you going to find 10 companies? I found 10 companies that are undervalued and have a wide economic moat, which means these companies have a competitive advantage. And despite the S&P 500 up a lot for basically the last 6 months or year to date, I found basically 10 companies that I want to share with you guys today. As always, please just remember this is not a financial advice. This is just kind of giving you some stocks to look for there and to look at and do your own research, inshallah. And it's also a bit of an entertainment as well. Right. Before we do that, as always, if you can support the channel, that would be absolutely amazing. If you can join us on the Patreon account, where you get access to the Discord, where a lot of brothers and sisters are sharing very good practices. Also, I share with you guys all my buys and sells as I go along. I shared, there's a lot of dividend trackers that you can get your hands on. So things like the dividend calendar, the stock watch list, the ETF trackers, as well as the Sharia compliant investing ebook. And I do post basically other content as well in the Patreon account. So if you are interested, it will cost you about 15p per day, but it really genuinely helps the channel. Right, let's get started on these 10 companies we're going to talk about today. The most important bit that I want to highlight is the moat. So they all have a wide economic moat. That means these companies have a competitive advantage, and they also have a basically undervalued at the moment. So they are, according to Morningstar, they're all undervalued. Now, one thing I would love you to do is to make sure if it says, for example, the company's done basically their fair value is about 12%, 13% from where the fair value is. That doesn't mean you just buy straight away. Make sure you always have margin of safety. So if there is 12%, just basically make sure that you have another 10% on top of that. Whatever it is that you're looking for, make sure you got your basically margin of safety. If your margin of safety is 5% and the company is down whatever percent, then of course you make that judgment, inshallah. Everything else is more or less the same. So what we want to see is basically if the company pays dividend, is that dividend actually growing? Is it sustainable? Is it safe? We want to see where the company has been in the last 5 years when it comes to revenue, when it comes to EPS as well, because we want to see how the company is growing. We want to see if the company management is actually doing a good job with the capital that we are giving or they're getting from the banks and so on. We want to see if the company has a excellent free cash flow. Okay, some of these companies on this list might not have it right now, but they are growing that, and I will tell you which ones are. Total return in the last 10 years. Give us an idea where the companies have been over the last 10 years and what to expect in the next 5 years, next year and the next 5 years, and then also the valuation side of things. Right, so the first one is Air Products and Chemicals. This is one of the companies that I own. They do have a wide economic moat. They pay excellent dividends. Okay, it's a safe right now, 95%, which is very good. In terms of revenue growth, in terms of EPS growth in the last 5 years, absolutely nothing to worry about 6%. Profit margin, return on equity, and return on invested capital. Return on invested capital could be better, but these two are absolutely fine. Now, they have a negative $2.6 billion of free cash flow, but I think that only happened last couple of years. The company is now actively, the management are actually increasing their free cash flow, so we will see what happens in the next year or so, but the dividends are absolutely safe, so they have nothing to worry about when it comes to that, and the revenue is growing. So I'm gonna keep an eye on it. Okay, I'm not just gonna sleep on and just completely forget about it. I will keep looking at this company for the next couple of quarters or next year or so and see if the free cash flow actually comes back to positive, because it's only last 18 months and so that it's been actually a negative. Total return the last 10 years, we're looking about 9%, which is decent, and growth estimate next year is 9% and then 7% every year for the following 5 years, which is quite nice to see. 14% discounted right now, $303 basically is where the price should be right now. As you can see, it's $260 per share. The next one we're looking at is Autodesk, and this company does not pay any dividends. As you can see, they have a wide economic moat, 52 billion market cap, so they're not a huge company, but they are not small either. The last 5 years, they grew that revenue about 15%, compound annual growth rate, 66% when it comes to EPS, profit margin about 17%, return on equity of 65%, and 26% when it comes to return on investor capital, which is really good to see. So the management is doing a very good job with the profitability of the business, as well as of course the capital deployment and so on. Free cash flow right now is just less than $1 billion. Total return is so 997 million. Total return the last 10 years, we're looking about 16%, and growth estimate next year to 11%, 12% after that every single year, 12% discounted this year, $275 per share is where they think the price should be. Right now is only 240, so it's a long way to go, which is quite nice to see the fact that it's actually down quite a bit. Next one is GSK. This is one of the companies basically in the UK. I'm gonna do a big just a whole video on this company because a few people have requested. It is now Sharia compliant. They had a spin-off of Halal, I think, whatever it's called. So the consumers, just like what J&J has done, they sold out their consumer part. Okay, now they're just a pharmaceutical company, just focusing on that, making drugs and so on. So it'll be interesting to check this out. Again, it's one of the UK based companies. Now I wouldn't worry too much about this dividend side of things, because sometimes the Simply Safe Dividend does not have enough information about UK companies. However, you can check on Dividend at Max, a lot of the UK based companies, and as you can see, they were growing that dividend and then they had to cut it. And I think this is a lot to do with the spin-off. I think that's exactly what has happened. So nothing really huge to worry about in terms of dividend side of things. They give you $1.48, safety 70%, and the last 5 years in revenues basically has not grown at all, about 0%, which is weird, and 9% when it comes to EPS. So I don't know if this is something to do with the spin-off or something has happened to the company. So I'm gonna dig deeper and I'll let you guys know more information about this company later on. Profit margin, we're looking at about 14%, return on equity 35%, and return on invested capital of 28%. $6 billion of free cash flow right now, 6.8 in fact. Total return last 10 years, we're looking at about 2%. Growth estimate next year 12%, 5% after that, which is decent, and 26% discounted right now. $54 per share is where they think the price should be. Remember, this is in the US based version of the company. Like the UK based, of course, you can check that out on Simply Wall Street if you want to, and that's probably what we're going to do. J&J, we're looking at right now 384 billion market cap, wide economic moat. Now excellent dividend, 99% safety, 61 years of increase in it, so dividend king here. And growth estimate, so the compound annual growth rate when it comes to the revenue side of it, about 5%. 6% when it comes to EPS, profit margin about almost 20%, return on equity 22%, return on investor capital of 23% as well, which is nice to see, and $18 billion of free cash flow right now. Total return on the last 10 years, we're looking at about 7%. This is annualized, so every single year would have made about 7% on your money, which is quite nice. Growth estimate next year about 7%, 5% when it comes to the following 5 years, which is fine. This is what I expect from this company anyway, from 4% to albeit 10%. 2% discounted right now, $164 per share is where the price should be. I think this was one of the companies we talked about in the last video. We did the last 5 for July undervalued stocks, and at the time I think it was about 154 or so. Each price since then is gone up. They've reported the earnings and was a really good report, and I think on that day they were up about 5%, 4%, 3%, or whatever it was. So I was in the red for quite some time with this company, but now I'm on the negative. I will share with you guys how many the companies that I own, of course. NXPI is the next one is one of the semiconductor companies out there, 63 billion market cap. Now they do have paid dividends, okay, but safety is about 60%. Now this is now hitting that below the safety, okay, 61% and above is safe, so it's about just below that. Revenue is really great, the last 70% in the last 5 years. EPS massive growth. I think they probably acquired another business or so on, because this is not organic. 78%. Profit margin 21%, 32% in terms of the return on equity, 19% in terms of growth, return on invested capital, $2.7 billion of free cash flow. Total return up in the last 10 years, we're looking at about 15%. Growth estimate next year 13%. 10% after that every single year, 21% discounted, $320 per share is where they think the price should be. Next one is Rockwell Automation, another company that we've talked about quite some time. 31 billion market cap, has definitely wide economic moat. In 14 years of increasing that dividend, $5 is what you get, 70% safety. Revenue growth about last 5 years about 6%. EPS about 8%, and 13% profit margin, 35% return on equity, 20% return on invested capital, $1 billion of free cash flow right now, 10% in terms of the total return in the last 10 years, 18% growth estimate next year, and then 3% after that, 12% discounted right now, $315 per share is where they think the price should be. The next one is Sanofi. Sanofi is I think it's a French company. And 132 billion market cap. It is a pharmaceutical company. It has a wide economic moat. 24 years of increasing that dividend annually. You'll get about just over $2. 90% safety. 5 year in the revenue. The revenue growth for the last 5 years about 5%. EPS about 11%. 10% profit margin. 5% return on equity, and 9% about return on invested capital, which is not huge, but it's all right. 7.8 billion market free cash flow right now, 3% in terms of total return last 10 years, 16% expected to grow about 16% this year. The following year, about 9% for the next 5 years, which is quite nice. 14% discounted right now, $61 per share is where they think the price should be. We've got 3 more to go, and that next one is TSMC. Again, one of the best companies out there in my opinion, one of the companies that the entire world relies on. 774 billion market cap right now, wide economic moat. In terms of dividends, I don't think they focus much on the dividends, but 14% and the 10% is actually quite nice. But they don't grow it every single year. So, but you get $2.46, safety about 62%. The revenue growth in the last 5 years, we're looking at about 17%, 16% in terms of EPS, profit margin, return on equity, and return on invested capital, absolutely amazing. Almost to $14 billion of free cash flow. Total return last 10 years, we're looking at about 24% annualized, which is absolutely amazing. Growth estimate next year 26%, 22% after that, and then 24% discounted right now. $213 per share is where the price should be. Now this is one of the companies I would love to own. I did own it until basically trading 212 changed and I think something to do with the government. You cannot own companies in Taiwan and China and so on in an ISA account. So that has changed, and because of the rules that has changed, I had to sell it. And then so I used to own it, and then I think I owned it as well on the free trade account, and then at the end I end up selling it. Anyway, so yeah, you cannot buy it within an ISA account, but you can buy it outside ISA account, which is something, if you're interested, you can look into, inshallah. Hershey Company is another one that I own right now. It's about 40 billion market cap. Really great company. 14 years of increasing that dividend. 80% safety. Growth in terms of the last couple of years, absolutely amazing. Latest increase was about 15%, and the 5 year basically was 10%. Now, in terms of revenue, we're looking at about 8%. In terms of EPS, about 22%. Profit margin 18%. Return on equity of 54%, and return on invested capital 28%, which is really good. 1.3 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 9%. Next year, they expect the earnings to grow absolutely nothing. I think it's going to be a flat year. In fact, I just want to check very quickly to see if that what the expectation is in using Seeking Alpha. So that is probably the reason. And then the following year, absolutely nothing. So this year is actually in decline. Next year is absolutely nothing. And then the following year is about 8%, 7%, which is where normally this company has been. In terms of revenue side of things, more or less the same. So 2%, 3%, and so on. So yeah, that's basically true here. 8% discounted right now, 220, basically $10 per share right now. Basically that's the price they expect it to be. I don't have anything to worry about in this basically for this company. Of course, the fact that it's going to grow basically double digits, or well, closer to double digits for the following couple of years, that I don't mind at all. And right now, my time horizon is probably about 2030 or so, and I'm going to hold on to this one. I like the dividend. I like the product that they sell, unless there's a huge problem. The cocoa price will probably come down. Once it does, then of course all the margins will start improving as well. So I have nothing to worry about. That's what I'm trying to say. UPS is another company that is down so much right now. It's about 14% discounted. Great when it comes to dividends. They've actually increased it just 1% this year, but 12% in the last 10 years, which is last 5 years, which is really good. In terms of safety, 69%, which is really good. Basically, revenue grew about 6%, APS about 6%, profit margin, return on equity, return investor capital, nothing huge to worry about. In terms of profitability, I think this will change in the next couple of quarters. $4.6 billion of free cash flow right now. Total return the last 10 years about 5%. Growth estimate next year about 19%, then 3% after that every single year. 14% discounted, $150 per share is where they think the price should be. Right now it's only 128%. This is the reason why I love buying. So I love buying companies when they are basically, when no one loves it and when basically people are trying to sell it. Especially if the business it might have a tiny bit of a decline, this and that. But this company is struggling because of the label and the basically side of things, okay, because of the labor contract that they've got into recently. But they are acquiring other businesses. They bought a Mexican company that is going to do so many deliveries in the whatever next couple of years. So the business is still growing, but the issue is just they had to spend upfront a lot of money to actually just sort out these labor contracts, and that's the only reason why it's down so much in the last few months. And of course, because of the economy is not great, people are not just ordering as much as they ordered during COVID times and so on. So yeah, will be interesting to see in terms of Sharia compliance side of things. You can have a basic look at that, pause the video and have a look at it in a bit more detail. As always, like I said to you, please don't take this as financial advice. Make sure you do your own research. These are just for entertainment and just kind of give you an idea of some of the companies out there. Finally, I just want to show you Air Product and Chemicals I do own in this portfolio. What else do I own in this Hershey? Again, I'm up about just to 1%. J&J is another company that's still undervalued, but I'm up about 4% right now. What else did we talk about? And UPS as well. Okay, so these are the 5 companies or 4 companies I own that we talked about today. Have a wonderful day, and if you want to support the channel, please join us on the Patreon account where you can get access to all of these things and support channel as well. Have a wonderful day. Assalamu Alaikum.